This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hi, welcome to the Financial Standard podcast. My name is Matthew Y, and I am a journalist at Financial Standard. At a time when volatility remains sky high, many investors, especially those making long-term investments, are seeking better security and protection against some of the rockiest global events, such as the recent bombardment of tariffs coming from Washington. Today we have Syed Zamil, Senior Product Specialist at Insight Investment, to discuss what kind of investment he thinks may hold the best value for these investors. Hi Syed, thanks for being with us today.
Hi, good to be with you. Thank you.
So right off the bat, why do you think high yield may be better valued for long-term investors as opposed to range trading strategies? Doesn't this asset class traditionally carry a higher default risk?
In our view, high yield remains very misunderstood. I think the fear of default, perhaps because, now we call it high yield, it used to be called junk bonds. It has kept investors out. But perhaps it'll be surprising to know to your listeners that if you go back over 2 decades, in fact, the start of the century, high yield has delivered a return of about 6.5% per year, which is just shy of stocks, but it's done it at about, 55, 60% of the volatility. So for that reason, we love this asset class. And, defaults are definitely, they're not great, but defaults are a bit blown out of proportion. If you look at a high yield default this year with all of this tariff tantrum, intermixed with tariff truce, the default has been non-existent, just 0.2%. The last 1 year, 0.67%, last 3 years, less than 1% at 0.88. And so defaults happen, but investors, in our view, are more than adequately compensated for that risk.
When it comes to fixed income, particularly corporate bonds, how important is looking at a grading of the bond when making an investment decision?
Yeah, certainly ratings matter. I mean, maybe everybody knows this, but just to level set, lower the rating, more the risk, and higher the compensation. And right now in high yield, you're getting ample compensation. Compared to, say, back in 2021, this is, sort of after peak COVID when central banks around the world moved aggressively to lower interest rates, high yield was only offering a yield of about 4%. Today, you get 7 to 7.5% yield. And as I just mentioned a minute ago, defaults have been pretty much non-existent. So you're getting a pretty healthy yield of, 7, and I don't know what it was just today, but 7.5% say in high yield. And corporate bonds remain on solid footing. We expect default to remain low. Now, that's high yield. Now, if you think about investment grade, these are the safest companies, right? Rated AAA down to, say, BBB, which is investment grade. They're offering a yield of about 5.25%. So you're picking up more than 2% yield for high yield bonds today. With defaults remaining low, we think it creates a pretty compelling value proposition.
For a lot of investors, their fundamental goes to buying low, selling high. But why doesn't that theory necessarily work in high yield?
Yeah, that's a really good question. And, the short answer is you just give up too much carry when you're not invested in high yield. The opportunity cost is high. As I just said, high yield delivers anywhere from, 7 to 8, sometimes up to 9% in yield. And if you buy low and sell high, that means that there are periods of time when you are out of the market. And it could be an extended period. And basically, when you are out of the market, you're giving up. Basically, let's say you're out for 1 month, you give up 1/12 of that 7.5%. If you stay out half the year because you think spreads are too tight or valuation is too unattractive, you give up half that yield. And so for that reason, the buy low and sell high just doesn't work. We find that it's better to stay fully invested, or at least invested enough so that you can collect that premium through sort of thick and thin.
So, what typically makes the asset class so attractive at the moment? Because, investors have other options of like equities and, other sort of
Yeah.
bonds. But what makes it so attractive?
Yeah. And we always endorse a diversified sort of asset allocation approach. But that said, we believe that we're kind of in the sweet spot for high yield right now. If you look at sort of the macro backdrop, the economy, and I'm talking about the U.S. economy now, we're talking about kind of the U.S. high yield market, but it also applies to global. The GDP is expected to be in the 0 to 2% range, which is slower. So we're expecting slower growth, and equities, although 0 to 2% doesn't sound terribly bad. The stocks are priced on future earnings growth, which again, with GDP slowing, we expect that earnings will also be slowing. Now, corporate bonds, whether it's investment grade or high yield, those are priced based on default probabilities. And right now, defaults are low, and we think that they'll remain contained. And so while a slowing GDP and a slowing economy, might mean that stocks might experience a little bit more volatility, we think that the attractive sort of yield that high yield is offering to investors, that 7.5%, is a really kind of a nice diversification for this volatility that may come up for stocks. And just as an aside, your listeners probably don't know the category of high yield bonds called fallen angels. The fallen angels actually are bonds that are downgraded from investment grade to high yield. And these specific sort of bonds, these fallen angel bonds, thrive during market turmoil. And so, this is a really interesting time to consider high yield because, the reasonable growth but slowing means stocks might face some volatility, but as long as defaults don't spike, which we don't think they will, you're going to get a pretty healthy income from being invested in high yield bonds.
As you mentioned, which is very interesting, the fallen angels, in terms of how they thrive in market turmoils, why would you select those like high yield stocks for long-term investments?
Yeah, thank you for that question. So fallen angels are if high yield is misunderstood, fallen angels are not just misunderstood, they're also kind of underfollowed. People really don't understand the dynamics around fallen angels. So just to maybe for your listeners to describe what a fallen angel bond is. A fallen angel bond, this is a corporate bond that was once rated investment grade, so the higher sort of ratings, either AAA, usually triple B, which is the lowest category of investment grade. But, sometimes these companies, and these are usually blue chip companies, that get a slap on the wrist because maybe their earnings have declined a little bit. Maybe their debt levels have gotten a little bit higher. And so the rating agencies, S&P, Moody's, and Fitch, they'll say, hey, get your act together, improve your earnings, lower your debt. And, until you do that, we're going to lower your rating from investment grade to high yield. Now, what happens when this bond falls, i.e. fallen angel, falls from investment grade to high yield, you have what we've seen as a lot of forced selling. There's a lot of holders of this bond that once it falls to high yield can no longer hold that as a bond. So index funds, for example, they held that bond because it provided some sort of risk profile that it matched. But once it falls out of that benchmark and falls into high yield, it's now a risk for them and they can't hold it. So they end up selling. Insurance companies face regulatory restrictions on how much sub-investment grade exposure they can have. They end up selling. Bottom line is, when this bond falls from investment grade to high yield, there's so much selling pressure that it leads to an oversold position that as a fallen angel investor, you can capitalize on. You can buy these really kind of blue chip companies, the bonds, at pretty discounted prices. And what our research shows is that after you're able to buy them at those discounts, they tend to recover all of the lost ground in the subsequent 12 to 18 months. And so as we're heading into this period where uncertainty seems to be the word of the day and the economy is slowing, we're expecting more downgrades from investment grade to high yield. And that should lead to pretty interesting opportunities for these fallen angel bonds.
Yeah, that's really interesting. Those are all the questions I have for you today. Thank you so much for your insight.
Thank you very much.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.